Oh, yeah, hey, Dom, you mentioned that CSX is down more than 20% year to date, but it's traded pretty much in line with the S&P quarter to date. That's basically since those rail strike fears were at least, delayed. A final deal still pending, but looks like it's on its way. So we're going to show you the estimates for revenue and profit in just a second. They're supposed to go up about 13 and 14% respectively. But one of the most important numbers in this report is the one we're showing you right now. That's operating ratio. It's an efficiency metric. And actually, the lower, the better. The estimates forecast a quarter to quarter increase. Something to watch. This stock can trade lower on a operating ratio number that's higher than expected. After that, the container business is very important. CSX gets about 15% of its revenue from shipping containers, also called intermodal, with more and more imports going to East Coast ports. This East Coast rail is expected to be a beneficiary, so certainly something to watch. Also, CSX has seen its overall volume increase in recent weeks. And then after that, we're looking for the commentary on the call from new CEO Joe Heinrichs. He took over last month. What he says on the call about labor, both the cost and retention, very important. Also, forward guidance. Last quarter, CSX guided for double-digit revenue growth. However, revenue's already up 25% in the first two quarters. So a lot of questions that they might raise guidance or put out some more clear guidance as far as revenue.
All right, David, what's the trade here, given what we saw from Union Pacific already earlier this morning?
So I was going to say there's probably a pretty good read-through from Union Pacific. So they had good numbers, but they gave a little bit more cautious guidance, and the stock is down significantly. So we wouldn't buy CSX in front of the print. We think they'll have an okay quarter, probably the same headwinds in terms of guidance. Throw in Hurricane Ian, and that has created possibly some issues for them because they're the most exposed from the big U.S. railroads. Longer term, if you have a 6 to 12-month time horizon, we think the railroad group is poised to do better. We think CSX is poised to do better. We like UNP, the best of the group, but CSX for the longer term is also a good trade. We would not buy in front of today.
All right. Next up, we got Snap also reporting after the bell today. Shares are higher into the print, but more than 80% below their highs and on pace for their worst year ever. Julia Borston has the story here now. Julia.
Well, Dom, the big question for Snap is whether or not it's going to show accelerating growth. The company has warned that it is expecting, it couldn't even give guidance because the outlook was so murky, but analysts are expecting about 6% revenue growth, down from 13% in the prior quarter. So the question is what kind of insight Snap gives. It usually gives insight into what's happening so far in the quarter. So it'll be really interesting to see if they've seen even any indication that ad revenue is picking up again. Then, of course, there's the question of user growth and whether Snap has been hurt by the popularity of TikTok, which is something we expect to hear from Meta about as well. And then, of course, with Snap, they're so invested in augmented reality. The question is how those AR ads are helping boost their advertising revenue. And one reason, Dom, we are watching these Snap numbers so carefully is because that could give us a sense of what to expect from Meta and others.
All right, David, what do we think about Snap? Buy it, sell it?
So this is one that we also would not get involved with. The company no longer is in bubble valuation territory because it's down 80%, and probably on an asset value play, it's okay from here. However, we do think it's the weak player in the group. We do think it will give you some insights into advertising in the group, give you some insights into Meta and Google. Our preferred stocks to play would be the Meta or the Google. Much less speculative, much good upside, much less downside. So we wouldn't get involved with this company before, probably, or after, but we do like the group and do like the Google Meta.
All right, finally up on the earnings exchange, Verizon reporting before the bell tomorrow. It's higher today and on pace for its best week since July, and competitor AT&T reported blowout earnings before the bell today. So will Verizon follow suit? The AT&T trade, probably the big tailwind today, Julia.
Absolutely. That's why Verizon is trading higher. But AT&T beat on those key subscriber numbers. Verizon has lost subs the last two quarters. The question is whether they will turn things around and be able to follow in AT&T's footsteps or whether they are going to be telling a different story.
All right, David, AT&T or Verizon, which would you rather?
Well, we would rather Comcast, which is in a similar group. But in terms of Verizon, we would not read through for AT&T. AT&T gained subscribers. It might have come at Verizon's cost. So we wouldn't buy in front of this. They've had some disappointments in the last few quarters, and we're a little bit worried about this quarter as well. Stock is really cheap, pays a good yield. We just think there are better places to make money out there.
And, of course, Comcast, the parent company of this network here at CNBC. All right, thank you guys very much. David Katz, our trader, also to Julia Borston on media, and to Frank Holland on the rails as well.